Fortune magazine named one company America's most innovative company 6 years in a row, from 1996 through 2001. That company reported $101 billion in revenue in the year 2000 alone, the seventh largest corporation in the United States by that measure. Then, in the fall of 2001, its credit rating fell out of investment grade, and 24 days later, it had filed for the largest bankruptcy in American history to that point. The company was Enron. Not a startup, a Fortune 500 energy giant with thousands of employees and auditors signing off every single year. Today on Collapse, we open the file on how a company that looked that solid turned out to be almost entirely an accounting trick, and why that trick is worth understanding right now in the middle of another boom built on promises of future profit. Chapter 1. The Founding. Enron was formed in 1985 when Houston Natural Gas merged with Internorth, a deal engineered by Kenneth Lay, who became chief executive of the combined company. At first, Enron was exactly what it looked like: a natural gas pipeline operator, a real physical business moving gas from wells to customers. But the 1980s and 1990s brought sweeping deregulation of energy markets, and Lay saw an opportunity that had nothing to do with pipelines. Instead of just delivering gas, Enron could trade contracts for future gas delivery, becoming a financial market maker for energy itself. That pivot from moving a physical commodity to trading paper claims on it is where this story actually begins. It is also, if you squint, the same pivot a lot of asset-light AI companies are making today. Physical infrastructure is the boring part. The contracts written on top of it are where the valuation lives. Chapter 2. Mark-to-market accounting. In 1992, Enron won approval from the SEC to use mark-to-market accounting for its long-term energy trading contracts. Normally, a company recognizes revenue as cash actually comes in over time. Mark-to-market let Enron estimate the entire future value of a multi-year contract, say a 20-year deal to supply power to a utility, and book the whole projected profit immediately, based on Enron's own internal models of where future prices would land. If the model was optimistic, the profit looked real today, even if the cash was not expected for another 15 years. This is the single most important fact in the whole story. Nearly everything else, the partnerships, the fraud, the collapse, exists to paper over the gap between the profit Enron had already booked and the cash that never showed up. Chapter 3. Enter Jeffrey Skilling, a former McKinsey consultant who joined Enron and pushed the trading business and the mark-to-market philosophy behind it into every corner of the company. Under Skilling, Enron stopped thinking of itself as an energy company and started calling itself something closer to an idea factory. Broadband trading, weather derivatives, water contracts, anything that could be modeled, marked to market, and booked as profit today. Skilling built a culture that rewarded traders and executives for signing deals that looked good on a spreadsheet, not for collecting cash years later. He became CEO in February 2001. By then, the company's reported earnings had drifted a long way from the cash actually moving through its bank accounts, and almost nobody outside a small circle of executives understood how wide that gap had become. Chapter 4. If mark-to-market created the gap, Chief Financial Officer Andrew Fastow built the machinery to hide it. Fastow set up a network of off-balance sheet partnerships with names like LJM1, LJM2, Chuco, and Jedi, the letters L, J, and M standing for his wife Leah and his two children, Jeffrey and Matthew. These entities raised money from outside investors, but Fastow personally ran them, which meant he was negotiating deals with Enron on one side of the table and running the buyer on the other. Enron used these partnerships to move underperforming assets and mounting debt off its own balance sheet. So the parent company's books looked clean, while manufacturing paper profits from the transactions between Enron and the entities Fastow controlled. Fastow personally made tens of millions of dollars in management fees from partnerships whose entire purpose was to make his own employer's balance sheet look healthier than it was. Chapter 5. In August 2001, an Enron vice president named Sharon Watkins wrote a 7-page letter to Kenneth Lay, who had returned as CEO after Skilling abruptly resigned that same month, citing personal reasons. Watkins laid out in plain language how the special purpose entities worked and why the accounting behind them would not survive real scrutiny. Her letter contained a sentence that would later become one of the most quoted lines in corporate history. "I am incredibly nervous that we will implode in a wave of accounting scandals." Lay had the concerns reviewed, but largely by lawyers with ties to the very structures in question. The warning went up the chain and effectively stopped there. 3 months later, almost exactly what Watkins predicted began happening in public, in real time, in front of every investor holding the stock. Chapter 6. On October 16, 2001, Enron disclosed a $638 million third-quarter loss and a $1.2 billion reduction in shareholder equity, tied directly to unwinding transactions with Fastow's partnerships. The explanation Enron offered investors on the earnings call was famously confusing, and reporters and analysts who tried to model the company's actual cash position could not make the numbers reconcile. 6 days later, the SEC opened a formal inquiry. On November 8th, Enron filed a restatement admitting its earnings had been overstated by $586 million over the previous 4 years, and its debt understated by $628 million, dating all the way back to 1997. In plain terms, the company confirmed in an SEC filing that years of previously audited profit had not actually existed. Chapter 7. Enron's stock had traded above $90 a share in the middle of 2000. By the start of November 2001, weeks after the restatement, it had fallen below $12. Enron's last hope was a buyout by rival energy trader Dynegy, announced earlier that month as a lifeline. On November 28th, Dynegy walked away from the deal after its own due diligence turned up more problems than it was willing to absorb. That single announcement did 2 things simultaneously. It sent Enron's stock crashing below $1 a share, and it triggered credit rating agencies to cut Enron's debt to junk status the same day. A company that had carried an investment-grade rating that same week was suddenly frozen out of the short-term lending markets it depended on to fund daily operations. There was no more room to maneuver. Chapter 8. 4 days after the credit downgrade, on December 2, 2001, Enron filed for Chapter 11 bankruptcy protection, listing $63.4 billion in assets, the largest corporate bankruptcy the United States had ever seen at that point. Roughly 20,000 employees lost their jobs. A large share of Enron's retirement plan had been invested in Enron stock itself, so many of those same employees watched their 401k savings evaporate alongside their paychecks, in some cases during a blackout period when they were barred from selling the very shares collapsing in value. Executives closer to the top, including Fastow and Lay, had sold significant blocks of Enron stock in the months leading up to the collapse, while encouraging employees and the public to keep buying. Chapter 9. Enron's outside auditor, Arthur Andersen, one of the 5 largest accounting firms in the world at the time, had signed off on years of the financial statements now known to be false. As the scandal broke, Andersen employees shredded a significant volume of Enron-related documents, which led to a 2002 conviction for obstruction of justice. The conviction was later overturned by the Supreme Court in 2005 on a technical jury instruction issue. But by then it did not matter. Andersen had already lost the trust of its clients and its license to audit public companies, and a firm that once employed roughly 85,000 people worldwide effectively ceased to exist. One accounting scandal did not just sink one energy company, it took down one of the most respected audit firms on the planet. Chapter 10. Andrew Fastow pleaded guilty to conspiracy charges and served roughly 6 years in prison, forfeiting $23.8 million. Jeffrey Skilling was convicted in 2006 and sentenced to 24 years, later reduced on appeal. He was released in 2019. Kenneth Lay was convicted on all counts in May 2006 but died of a heart attack that July before he could be sentenced, which under the law at the time vacated his conviction entirely. In direct response to Enron and a handful of contemporaneous scandals, Congress passed the Sarbanes-Oxley Act in 2002, requiring CEOs and CFOs to personally certify their company's financial statements under penalty of criminal liability, and imposing new rules on auditor independence. Every quarterly certification a public company signs today exists because regulators decided the honor system had already failed once, in public, at enormous cost. Chapter 11. Strip away the individual villains, and Enron's mechanism was simple. An accounting rule let the company book the value of a promised future today, and a culture of concealment kept anyone from checking whether that future was arriving on schedule. That is worth sitting with, because a version of the same question sits underneath the AI boom. When a company signs a multi-year cloud contract or a compute supply agreement, and the market immediately prices in decades of assumed future revenue, it is not fraud, but it is the same underlying bet Enron's model made, that a signature on a long contract is as good as the cash actually showing up. We covered a live version of that exact tension in our SoftBank episode this week. Debt raised today against a valuation that depends entirely on tomorrow going as planned. Let's close the file. Enron went from America's most innovative company to America's largest bankruptcy in 24 days once its credit rating cracked. But the real collapse had been building for years, one mark-to-market entry and one off-balance sheet partnership at a time. The company did not get caught lying about a single big number. It got caught building a financial reality that was, in the end, mostly narration. 20,000 employees lost their jobs and retirement savings. The executives who built the structure mostly did not. The next Enron will not trade energy contracts. It will trade something that sounds more modern, and it will ask the market to value it on the story of tomorrow instead of the numbers of today. Ask for the cash flow statement first. Subscribe now, because tomorrow the current returns with this week's biggest AI money story, and there is always one.